Between skyrocketing rent, unyielding student loans, and everyday inflation, your current financial foundation is likely under immense pressure. When you are navigating those immediate, heavy daily costs, long-term financial protection like life insurance gets pushed to the back burner. It feels like a someday problem. Putting this off has created a vulnerable reality. Right now, more than half of millennials have absolutely zero life insurance coverage. Treating coverage as a disposable expense leaves you exposed, and it means you are passing up a highly leveraged financial opportunity. The main reason young adults skip coverage isn't a lack of interest, it is a massive misunderstanding about the price. This chart illustrates the perception gap. Actuarial research shows that healthy people under 35 routinely overestimate the cost of a basic term life policy by 10 to 12 times its actual market price. People often assume these premiums will mirror their expensive monthly car insurance bills, keeping them from even looking into a quote. By avoiding a phantom expense, you are unknowingly throwing away your unique status as a low-risk policyholder. Insurers calculate your premiums based on a specific mathematical reality, your statistical health and age at the exact moment you sign the contract. This graph tracks premium costs over time. Look at the trajectory. Locking in a policy at age 25 rather than waiting until 35 cuts your total premium cost over the life of the policy by thousands of dollars. You are buying the coverage when you don't need it, specifically so it remains affordable on the day you eventually do. Securing a policy in your 20s is a strict optimization strategy. You lock in a permanently low rate that lasts for decades. Let's look at term life insurance, the entry-level building block of a solid protection plan. Here is a breakdown of protection options. Under term life, purchasing a 10, 20, or 30-year policy secures a massive, tax-free death benefit for anyone relying on you. The trade-off is simple. Unlike permanent life insurance, a term policy holds no cash value investment component. That lack of an investment vehicle is exactly what makes it so cheap. It frees your monthly cash flow to invest in other assets, like stocks or real estate. Term life gives you a way to keep your family financially secure without draining your current investment budget. We also have to account for the rising rates of lifestyle-related illnesses and non-workplace injuries affecting young adults today. Critical illness insurance acts as a savings shield. It pays out a tax-free lump sum upon the diagnosis of a covered severe illness. It only triggers for specific diagnoses, but it ensures your long-term savings aren't wiped out by sudden medical costs. Then there is disability insurance. Think of this as an income engine. If you are physically unable to perform your job, this policy steps in to replace 60 to 85% of your earnings. If you rely on your own paycheck to survive, protecting that income stream and your personal savings is a non-negotiable necessity. The strategic move tying all this together is timing. You need to acquire these policies before a chronic condition is ever diagnosed. Buying early guarantees your insurability for life. Your policies remain renewable even if your health drastically declines later on. Health policies enforce mandatory waiting periods of up to 3 years. Buying early clears them harmlessly while you are young and healthy. Waiting until a health crisis hits triggers severe penalties. You face permanent premium surcharges, condition exclusions, or flat-out coverage denials. Allocating a small portion of your budget today permanently shields you from becoming entirely uninsurable tomorrow. You need to match your insurance products to your exact lifestyle and liabilities. Consider your current situation. Think about co-signed debt, a long-term mortgage, or people relying on your income. If you do, term life insurance should be your primary safety net. But for single professionals and gig workers without dependents, the priority shifts. You need disability and critical illness insurance to protect your solo income and personal savings. Private risk protection isn't a generic one-size-fits-all package. It is a customizable toolkit designed to adapt to your evolving financial life. Let's reframe the conversation around the actual daily cost of maintaining these premiums while you are in your 20s. Compare the true monthly cost of a comprehensive term policy against common discretionary expenses, like a few coffee shop lattes or concert ticket fees. You can spend that money on temporary lifestyle inflation, or redirect it to buy hundreds of thousands of dollars in financial peace of mind. Buying insurance young is an exclusive early adopter advantage. It is a strategy that older demographics deeply wish they had utilized when they had the chance. Stop viewing insurance as just another frustrating monthly expense. Start treating it as the absolute smartest financial asset you can acquire today.